So we are starting with equity subject, and before directly starting to answer learning outcomes, I thought it would be a good idea to get ourselves acquainted with what is the expectation out of the level 2 curriculum. So I picked up the research reports on couple of stocks. So we are looking at one particular report from Street Ratings. It's a research house, but it's more of a media company, and they have a report on the Starbucks Corporation. So I'm going to show you some of the key points in this equity research report, and then we would try to link those points with all the learning outcomes that we have, so it would be much more easier to imagine. So now, because they have a unique rating philosophy here, they've given this a buy rating with A minus score, but this is not a common feature in all the equity research reports. Now, it clearly says it's a buy. We have been quoted what is the current price of the stock, and we also have what is the target price, which is being quoted as 77.11. There's also rating since feature, which is important because the rating on the stock might change frequently. So you would want to see a stock where the rating is constant for a longer period of time. So a lot of Indian equity research report might not have this feature. So there is some discussion here on what is the business model, where it says it operates as a roaster, marketer, retailer of specialty coffee. It operates in multiple areas. So it's a very brief description. Towards the middle of this report, we will also see a very elaborated discussion on industry, about what are the characteristics. So then stock performance, some key numbers are given: growth, ROEs, and then we also have PE comparison, price earning ratio comparison. So when we go towards the latter part of equity level 2, we would learn how the valuation is done based on different metrics. And one of the way of doing valuation is the relative valuation, where we would look at price to earning or price to book value. These are EPS analysis. So I've highlighted some of the key points so that we can run through it quickly. So here one thing that I liked about these reports, generally with most of the Street Rating reports, they're very clear with what they want to communicate with the investors. So we rate Starbucks as a buy. This is based on the convergence of positive investment measures, which should help the stock outperform majority of the stocks that we rate. Then there is discussion on operating cash flows, debt to equity ratio, earning per share. So they have in-depth discussion on each of those key metrics that they feel is appropriate. Then there is a good discussion on industry analysis. So precisely with the same name, we have a reading at CFA level 2, where they've discussed on what parameters do you analyze industry. And if you remember from level 1, we had Porter's 5 factors. So then they have a very long discussion on how do you think of Porter's 5 factors. So this is mostly coming from that sector. So it's very interesting to read through this. The hotel, restaurant and leisure industry consists of hotels, restaurants, casinos and blah, blah, blah. Demand is driven by a fairly consistent group of factors throughout the whole industry. Personal income levels, total employment and consumer confidence. In recent years, catastrophic weather, fear of terrorism, health epidemics directly impacted industry in a material way. Industries, capital, marketing, personal, energy, maintenance, technology, intensive. And then they have discussed who are the major players in this particular segment. Then there is a large discussion on peer group. So one of the learning outcome that we have at level 2 discusses how do you select an appropriate peer group comparison, on what parameters a peer group should be selected. So they have given list of lot of companies they think are peers and all the data about price to earning, sales and other variables. Then again we have some company description here, stock at a glance. Then they have this unique rating mechanism on growth, total return efficiency. And then they have discussed what is their research methodology here. These are, can you observe this E here? So these are expected or forecasted earnings. And and I'm sure many of you are already working in this sector, but most of the time when analyst comes up with a valuation, that valuation is typically a function of what is the forecasted earnings, not the current earnings, right? And certain, like for example, now we are towards the end of 15-16 financial year. So a lot of analysts will do forecasting based on earnings of 16-17. At times you might also see analysts doing valuation based on 17-18. Forecasting earnings 2 years down the line. So these are all the estimated earnings. Then valuation. So valuation is a clear-cut buy which is being given. We have discussion on price to earning, and based on price to earning, which category the stock falls into. Is it at a premium or is it at a discount? Then price to cash flow. And we have all those metrics. And then disclaimers about how do they do the valuation. So the idea with level 2 curriculum, that by the end of this syllabus, all of you should have a very strong theoretical background in terms of how do you do valuation of stocks using different methodology, and how do you come up with reports like this, what to include, what not to include. So of course, as a syllabus, it has limitations. So it does not cover financial modeling per se, as in you would not be taking an Excel file and doing valuation. But it will also describe, if you take an Excel file and if you decide to do valuation, then what should be the approach there. Any questions you would like to ask with this? So the first reading we are starting with is equity valuation, application and processes. Now from exam perspective, I do not think level 2 equity is going to be a challenge whatsoever. The only challenge is going to be that there is a large amount of theory in it. So it is not number crunching intensive the way FRA was, but there's a large amount of theory, and the challenge would be to be able to remember all those theory components. And I'll help you by doing a lot of questions in the first 30 minutes that we generally do. But I would recommend you start making short notes. So I would not be waiting for you, but if you can scribble fast and make notes, they would be extremely handy when you revise the subject. So I have built a flowchart to kind of have an overview of this reading. The first section of the reading is focused on the definition of value. So may I assume that all of you have a understanding of what is the difference between value and price of a stock? Value is what is the intrinsic worth of that particular stock. So there are different versions of the value. One is intrinsic. So whatever valuation you do, let us say FCFF, FCFE, relative valuation, and you come up with a number, we would typically call this as intrinsic value. Can you guess what would be a going concern value? So you assume that company will do its business forever. One easiest application to think of this is the Gordon growth model. So when we use Gordon growth model, whether we use it for FCFE or dividend, we say value at time 0 is equal to dividend at time 1 divided by KE minus G. Do you remember this? So when we say KE minus G, this formula is nothing but a simple growing perpetuity. Growing perpetuity is as in, what if your cash flow keeps on increasing at the same rate forever? And when we are doing this, what we are simply assuming is that the organization is going concern, it will operate forever. Are we fine with this? What do you think of liquidation value? Liquidation value is what if company is to shut down business today and decides to liquidate. So typically this value would be calculated as all the assets minus all the liabilities. But there is a concept of orderly liquidation value. It's not testable, it may be interesting to understand. So what this value really means is that valuation in case of liquidation would be a function of what is the time span available with the organization to liquidate. So imagine you have a real estate with you, and if you just have 1 month to liquidate, maybe you might have to compromise on your valuation. But if you get 3 months, you might get a better valuation. So this liquidation value is a function of how much time is available for liquidation, which is referred to as orderly liquidation value. Are you fine with this? Fair value, so they have given this a definition, but mostly used in the context of accounting. So there are two parties, they are knowledgeable, and then they exchange that particular asset. So that valuation is fair value. Investment value. So this is interesting. Now think of this carefully. So let us imagine there is an organization A. So this is a small CRAMS, operating in the CRAMS segment. So they are doing contract research in the pharmaceutical or healthcare space. Now there are two people who are willing to buy. Let us say, so the first organization is a large financial investor. So when this large financial investor decides to value or decides to acquire this organization A, then they might simply use a FCFF mechanism, or they might use price to earning relative value mechanism. But imagine there is a large pharma company which is willing to acquire this particular research company which is operating in the similar space. So when this pharma company tries to acquire, there would be a lot of synergy in that acquisition. Do you agree with me? And because that synergy would be factored into the valuation, this valuation would be substantially higher, or at least higher than what valuation we have by the financial investor. Making sense? So investment value means that value to a particular investor. So maybe investment value to large pharmaceutical company would be higher, and investment value of the same asset to the financial investor would be lower. Are we good to go ahead? So typically these type of deals, this is called as a financial investor, and this investor is referred to as a strategic investor. Right? And therefore a lot of mid-sized startups who have a reasonable business model which is working and who need more funding for growth, they have a preference for getting funding through strategic investor, because that provides a better valuation and better opportunities for growth. Then we have Grossman-Stiglitz paradox in the syllabus. So this paradox is actually coming from your level 1 efficient market hypothesis, if you remember that. So this paradox actually contradicts what efficient market hypothesis says. So listen to this carefully. What these guys are saying is, let us assume that markets are efficient. And if the markets are efficient, then there is no benefit of active investment. Do you agree with this? And since there is no benefit of active investment, there would be no money spent on research. There would be no money spent on using the financial modeling or whatever. So there would not be analysts tracking these type of stocks. And if there is no research done, then the stocks will deviate away from efficient prices. Agree? So if there is no one tracking the stock, then there is a high possibility that stock will deviate away from efficient prices. And if it deviates away from efficient prices, then the question that they raise is, then how can markets be efficient? Right? So they are essentially trying to prove that markets are not efficient by saying that even if they are efficient, inversely it might happen that the prices will move away because there is no one tracking, and that would again lead to inefficiency in the markets. Are we good to go? Are we good to go ahead now? Then there is one learning outcome which says in which all scenarios equity valuation would be useful. So it's useful for stock selection. It is useful for inferring market expectation. Akash, what would this be? Inferring market expectation. So this is what you used to do in your previous organization, reverse modeling. Right? So there are certain fund houses who use this mechanism of reverse modeling, where they say, so you have a FCFF financial model, and you have that job of the model is to come up with the intrinsic value. So you put that market value as an input into the model, and then it tells you what is the assumption markets have made about the revenue growth, about the earnings growth. Are you following what I'm trying to say? And then you compare the market assumptions with your own assumptions or estimates, and then you decide whether we should invest or not invest. For example, let us say that current market price of a stock is 500. Okay. So this market price of a stock 500 has come based on multiple assumptions. So typically what is the process of financial model? So you start with current data, then you would start forecasting that data. Right? So in this forecasting, you would figure out what should be the top line, what should be the revenue growth, then what should be the earnings growth. So you come up with all these numbers, and once you have come up with these numbers, then you would come up with the value of the stock. What you do in a reverse DCF mechanism, you input the price of the stock as equivalent to value of the stock, and then you figure out that what market are inherently expecting about the revenue growth and the earning growth of the organization. For example, the current price indicates that maybe markets are expecting that revenue will grow at the rate of 11% in the next financial year. And then you compare this with what is your own estimate. Do you think the revenue growth would be more than 11%? If yes, then the stock is buy. If no, then the stock is not a buy. Are we clear with this? So that is inferring market expectation. Then evaluation of corporate events. So in fact, both point number 3 and 4 is more or less the same thing. So what they do here is, if there's a mergers and acquisition scenario, then is the deal happening at an appropriate price? Okay, so maybe there's a corporate event happening, and is the acquisition at a too high or too low price? You take decisions like this, which is point number 3 and 4. And then evaluation of business strategy, valuation of business payments, and finally the share-based payment. What would this be? Yeah, so you want to compensate your employee based on how the stock performance is going to be. So you forecast what would be the stock price 2 years, 3 years down the line, and then depending on that you decide to give them ESOPs. So all the share-based payments, you need to have an indication of what would be the value few years in advance, as in few years down the line, 2 years, 3 years. So we use equity valuation for that purpose. Are we good here? Then there are 5 steps discussed in one of the learning outcome. So understand the business, then forecast what is the performance, then select appropriate valuation model, convert that forecast to a valuation, and then apply valuation conclusion. Any questions you would like to ask here? And then some of the important terms in the reading. Number 1 is SOTP valuation. Can anyone help me with this? This is sum of total parts. Right, so sum of total parts. So easiest way in Indian markets, think of ITC, which is kind of a conglomerate now, which has got multiple lines of business. So they have tobacco, and they have paper, and they have FMCG. So you cannot use one single model to value the entire stock, because the tobacco will have different growth trajectory, and other products will have different growth trajectory. So what you do is you find out the valuation of one business, then you find out valuation of other business, third business, then you add them up together. So that type of valuation mechanism is called SOTP, which is very oftenly used in corporate finance type of scenarios. Less popular in equity valuation, but more popular in corporate finance type of scenarios. Then conglomerate discount. What would this be? Yeah, so we talk about conglomerate discount very frequently in the context of L&T. Okay, so let's say L&T has Larsen, an infrastructure company in India. So we have nine different business units. Let me just say 3. So maybe valuation of one is 500, valuation of this is 200, valuation of this is 300. But because it is a conglomerate, and because maybe there is no direct synergy in these business lines, the combined valuation of the firm might turn out to be only 900, and that would be referred to as the conglomerate discount. Are we good here? So this is, you can think of this as similar to reverse synergy, where the combined valuation is less than the valuation of individuals. And blockage factor. Anyone here? It's about block deals. So I think on the on the day of previous Monday, the day when we had speech of the finance minister, there was a very large size block deal for Axis Bank stocks. It was almost one crore shares which changed hands. So when there are such large size block deals which are happening off the exchange between two parties, then the valuation of that particular block deal would generally be lesser compared to what price you have in the market. And that valuation is lesser because if you decide to sell the same stock in the market, there would be an impact cost. Right? Since suddenly the volume will increase on the sell side, prices will come down. So that discount in the pricing, that is referred to as the blockage factor. Are we good to go ahead? Okay, the question that is being asked, for ITC, can we apply a conglomerate discount? I think yes. I mean, in theory, yes, but I haven't heard people talking about ITC spinning off and then the value will unlock. But we hear that about L&T very frequently. But yes, I mean, in theory, since it is a conglomerate, we can have a discount there as well. If there is a synergy. I mean, if you think there's a synergy between tobacco and agarbatti business, maybe, maybe yes. Yeah. I mean, that's what blockage factor says. See, it could be other way around also. And depending on what is the scenario, at times the pricing could be higher or lesser. Because if you decide to buy a large quantity of shares in the market, then also the prices will spike up immediately. But here, for the exam purpose, they have discussed blockage factor, which is generally negative. Alright, so this is roughly the agenda of this reading. So if you would go through the CFA text, the curriculum, towards this, towards the end of the reading, it kind of becomes the ethics. So they have a very large discussion on how as an analyst you should be ethical, and they almost end up repeating the whole of ethics there. So there is some flavor of ethics. So on the exam, in an equity case study, if you see ethics question, you should not be surprised. It is coming from this particular reading. So we know what is a valuation, and we also know it is a skill-based approach. So other day, in fact, yesterday morning, I got an opportunity to talk to a buy-side equity analyst on Indian markets. And that's what we were discussing about, how effective the valuation calls of the models are. And the conclusion that we reached is that you do this so that at least you build models and you do all the tomfoolery around this, so that when you take a decision, psychologically you yourself feel that you're doing the right thing. But yes, ultimately, no matter how smart you are, how good you are at theory, how good you are at Excel, and how good you are at understanding business, at the end of the day, it is a skill. That's what most of the valuation people will talk about. So intrinsic value is true or real value of the asset. This was the paradox that we were talking about. So this gentleman is hedge fund manager. The other gentleman is, of course, Nobel laureates. And this is what the paradox said, that if market reflects the intrinsic, you don't need to write this. Just if markets reflect the intrinsic value, then all information is automatically reflected into the security prices. Then investor would not incur the cost to obtain information. Then market trading prices are not fully analyzed and informed prices. And then how would the market prices will reflect the intrinsic value? So they will eventually go away from the intrinsic values. This part you can write down. So you can give heading as breakup of alpha. Give heading as breakup of alpha. Breakup of alpha. Write down this particular equation, then I'll explain you what it is. It looks very fancy, but it's a very simple concept. Assuming you're done here, so you understand this. Let us say the current price current price of a particular stock is 100. Let us say an analyst built his financial model around this, and he came up with a intrinsic value estimate. Intrinsic value estimate. So this is what the analyst estimates. Let us say that he came up with an intrinsic value estimate of 150. However, the true intrinsic value, true in double quote, so true intrinsic value, let us say, is 120. Now don't ask me where do we get true intrinsic value, which is hypothetical concept, but let's assume it is 120. So what they are saying is, what this analyst might think, he might think that we have a potential upside of 50. Right? That's your potential upside, because you would buy the stock at 100 and it is expected to go up to 150. But this potential upside is made of two parts. This V minus P is the true upside, which is 20. And this VE minus V, which is 150 minus 120, is his estimation error. Are you following this? So this is a true mispricing, and this component that we have, that is the estimation error. 50 is the estimated alpha, out of which 20 is the true alpha, 30 is the estimation error. So what they're, I don't think they would put a numerical. It would be really stupid if they do that. But they're basically trying to say that a lot of time analysts will go wrong. They might end up overestimating the correct valuation of the stock. So that estimated alpha might not be entirely true. And then you can break it down into what was the true alpha and what was the valuation error. So this can be done ex post, not in advance. Right? So you take a report issued a year back, and then you do an analysis, and then you call the sell side guy and tell him that this is what your ratios have been. That's what this is trying to do. Should we go ahead? Because we make thousands of assumptions while valuing a stock. So going concern value versus liquidation value. Going concern is business will run forever. Liquidation is business will not run forever. So which value generally should be higher? Going concern. So in theory, but if you see now a lot of stocks, for example, think of Tata Steel today, where the estimate of book value is substantially higher than what is the current market price. Right? Of course, now if they liquidate, we do not know how much will that really be materialized, but in practice it could be other way around also, especially because of the sentiments in the market. But for exam purpose, going concern would be higher than liquidation values. Fair market value, investment value. Investment value is investor specific, whereas fair market value is generic valuation of that stock. Please answer the question. Are we fine with C? So where do we use equity valuation? So we use equity valuation in all these places. To select a stock, to infer market expectation, you can expect some numericals on this. Okay, for example, let me construct one for you. Let us say current stock price is 150. Expected dividend at time 1 is 15. Cost of equity is 20%. What is the implied growth rate? Assuming Gordon growth model. You don't need a calculator for this. It has to be 10%. So you would say valuation at time 0 is D1 divided by K minus G. Now since this is 150, since this is 15, this has to be 10%. And since this is 10%, growth rate has to be 10%. So these are the type of calculations you might see on the exam, if at all they decide to test, which is inferring market expectations. Are we fine here? Spin-off is spinning off one organization into smaller parts, 2 parts, 3 parts. Spin-offs, split-offs. We had learning outcome in corporate finance. No. So question he asked, will Google be an example? I don't know. Google, I would just say corporate restructuring. Yeah, so they made a parent company and so whatever, they restructured their business. So let's move on. So 5 steps of valuation. Understand the business. Then forecast company performance. This process is actually called building a financial model, financial modeling. Then decide which valuation model will you use. Convert a forecast to a valuation. And then apply the valuation conclusion, which is essentially writing your equity research report. Are you fine? Now, you cannot use the same model for all type of stocks. So depending on which sector you're modeling and what category of stocks you're looking at, you would decide what would be the appropriate valuation method. So this is a financial model we prepared, I think quite some time back. This was built on Hindustan Unilever. So if you would see, step number 1 is essentially getting a hang of the business about what industry are we looking at and what are the factors which affect HUL. For example, since it's a FMCG company in India, a very big impact is done based on what is the rainfall, what is the personal income, that is the rate at which GDP is growing. So these are some of your drivers. Then, so your first step is to gather data. So all this is, if you can see this is historical data which is being shown as A. And then in this step you start forecasting data, which if you can see, so this was built in 2013. So we have forecasted values of 14, 15, 16, 17 and 18. And once you finish your forecast, then towards the end you would come up with different valuation metrics. So since we were learning how to model data in the classroom in financial modeling, so we decided to use all the methods on one stock. And if you would see the difference in valuation, for example, our EV by EBITDA valuation, so our relative valuation was throwing a value of, if that's visible to you here, is that visible? It was throwing a valuation of about 600. But the same stock, when we decided to do a valuation using DCF, that valuation was 330. So depending on which sector you are modeling, what type of stocks you're modeling, what are the trajectory and what is the convention in the industry, you'll have to decide which method to use where, which is your point number 4. Okay, so understanding business, they have some discussion, just a brief discussion on Porter's 5 factors. However, we have a separate reading only focused on these 5. So intra-industry rivalry is in how fierce is the competition within the sector of the players. Can you think of any industry in India where the competition is very intense? E-commerce, yes. Telecom might be a good sector. Even aviation is good. Then the fear of new entrants. Can you think of any sector where getting in is relatively easier? IT sector. So all service sectors, industry which is predominantly service sector, is relatively easier to enter. Then possibility of substitutes. So think of the diesel and petrol cars. One big substitute that's coming rapidly is the electric version of cars. So that is your substitutes. Then bargaining power of suppliers. Can you think of any? Bargaining, a scenario where suppliers have a very strong bargaining power. Petroleum? No, I think, so you can think of most of the diamond based businesses. So there is one major diamond producer which is, or the one De Beers, if you've heard of them. And so these guys kind of have a monopoly in extraction of diamonds. So they might have a very strong bargaining power as a supplier because they're one of the major players in that segment. And then bargaining power of buyers. Here you can think of automobile component industry in India. and where you're typically reliant on only one or two company buying majority of your products. So then you look at all of these factors and then decide what is the outlook of the industry. So we would discuss more about that when we get into that reading. Then they have also discussed certain strategies. So first is cost leadership. So now you can think of Micromax mobile phones in India. So when they decided to enter the market, they had a very clear strategy of focusing only on the low cost phones, producing or sourcing at very large quantities and targeting that particular segment of the market. Differentiation, so within mobile phones you can think of maybe Samsung and Apple. So they do not want to be the cost leader. In fact, Apple spends almost 4% of the revenue in R&D. So they do not intend to be the cost leader, they want to be the product differentiator. Their product should be so unique that it would be difficult for others to compete. And then focus is, you choose a smaller segment of the market and then you focus only on that particular area. Do you want to ask any questions here? Focus is, yeah, just taking a niche part of the industry and working. So I think you can think of, there is some Rio drinks, if you've heard of them. Have you heard of these guys? So they have a very narrow focus, right? So they don't try to compete with Pepsi or Coke in a direct fashion. They have a particular segment of the market where they sell. They try to sell only on that particular market segment. So these type of people who take a small segment of the market and only focus, these are the focus players. So in management literature, this is considered as a strategy to enter into a very fierce industry. So when you want to enter into a market segment, and if the competition is too intense, you take a small component of that industry, you start working on that, build a focus, and then grow further. Okay, then quality of earning analysis, I'm sure all of you understand this. So again, the key word here is sustainability. Risk factors which might signal negative earning surprises in future. So poor disclosures, related party transaction, excessive employee loans, high management turnover, excessive pressure on management to meet earning targets. Want to discuss on any of these points? So if you see this happening, there's a possibility that we might have a negative earning surprise coming up in near future. So if there are too many employee loans, maybe there is a bad corporate governance that's happening there, where employees are not working in the best interest of the shareholders. The management is working in the best interest of employees or themselves. Because of the negative corporate governance, possibility of negative earning surprise. Related party transaction is, so I was thinking of an example, but yeah, so easiest way is that most of your products are being sold to a sister organization. Or, no, so this is not arm's length price. Arm's length means a fair price. So related party are generally not the arm's length price. So yeah, maybe one example that might fit in. So let's avoid the name, but let's say a lot of big investment banks which are based out of US or UK, they set up KPOs in India, so that a big chunk of that work gets outsourced, right, which is typically back office and some part of middle office. So these KPOs in India are registered companies here. They have to be, because they have a legal setup. Now the only job that these KPOs do here is to provide services to the parent company in US. Now imagine, during the year, the cost of operation of this KPO was, let us say, $300 million. Cost of operations was $300 million. Now what calculation these guys would do is that, what is the tax rate where the parent is situated? Let's say the tax rate here is 20%, because they have some beneficial tax arrangement. What is the tax rate in India? 30%, with a promise to go down to good level over the period of few years, but 30% right now. So what strategy these guys might use is, since the tax rate in India is higher, while selling these services by KPO to the US company, they will sell them only at a valuation of 300 or maybe 310 or maybe very small profit margin, so that in India the profits are lesser, and since India profits are lesser, you end up paying lesser amount of taxes. But in US or maybe wherever the parent company is situated, the profits are higher because you're buying cheaper, but you end up paying taxes at a lower price. So these type of transactions are called related party transaction. Right? And if there are related party transactions, again it's a red flag, because then you're not completely sure about what's happening. So of course in India, so income tax department is aware of these things. So there is a transfer pricing department only for this. I think most of the chartered accountants might know. And then this transfer pricing team of the income tax division, they would look at what is the profit margin charged by this KPO, and is it sufficient, is it not sufficient? And if not, the assessing officer might just ask him to book profit of XYZ amount with whatever remarks he has, and then he'll have to pay taxes. The KPOs will have to pay taxes in India. Are we good to go ahead? Then material non-audit services performed by audit firm. Why is this a red flag? Huh? Yeah, so you're keeping your auditors happy, you're giving them a lot of consulting work, and therefore you become a key account for the auditor, and therefore they would be extremely careful while making negative remarks in the annual report. Then frequent change of auditors, management's compensation tied to profitability, pressure to meet debt covenants, history of security law violations. Any questions here? So it is always tied to profitability, but imagine now, so you are manager of an organization, and you have an exit plan for yourself in 2 years, which of course the company doesn't know yet. So what you might do is you go extremely aggressive with your assumptions and accounting, try to book as much profit as possible in next 2 years so that your compensation is higher, and then once you exit, then in the books effect would be reversed, but you don't care because now you care about the next organization. So it is not that it is always a concern, of course it would always be, but you need to be a little careful on this front. So most of the countries have laws around this in terms of if there's a change in management, very frequent. So management pressure to meet debt covenant could be something like your operating cash flow should always be the ratio of operating cash flow to interest, or interest to operating cash flow should be twice. CFO should be twice of interest. For example, it's a covenant. Then management has an incentive to inflate CFOs. If not, then they would be in violation and they might have to redeem all the bonds. Should we go ahead now? Alright, so top-down forecasting approach, bottom-up forecasting approach. Can you help me with top-down? Yeah, so since these are forecasting approaches, so how do you think of this? So let's say you want to model revenue of Hindustan Unilever. It's again FMCG company in India. So step number 1, you find out what is the current GDP size, not the percentage, what is the current GDP. Then step number 2, you find out what is the industry size. Then step number 3, you find out what is the market share of the organization. Are we fine? So it might work out something like this. Let us say current GDP is 100, industry size is about 5, and market share, so the revenue, total revenue is 1. So when you convert this to percentage, this industry is about contributing 5% to the GDP of the country, and within this industry the contribution of this particular stock is 20%. So when you're doing a top-down forecasting, you try to estimate what would be the GDP of the country next year. Maybe let us say that would be 120. Then you try to estimate what would be the contribution of this industry towards GDP. Let's say 6%. That means total market size now 7.2. And then you estimate what would be the market share since I want to keep calculations easy for me, 50%, and therefore it would come out to be 3.6 revenue next year. This is a top-down approach. As against what would be a bottom-up approach? Huh? Are you asking a question or you answering? Answering bottom-up. Yeah. Top-down. Bottom-up. Yeah, so bottom-up approach would be you look at HOL is launching which product next year. Maybe their Lux product is being advertised this time by Shah Rukh Khan. It's already been advertised, right? But let's say some XYZ is going to do advertisement, or they are launching 2-3 new business, or they are expanding Lakme salons or whatever they're doing, and because of which you think top line will grow by 5%, bottom line will grow by 3%. So that particular approach is referred to as bottom-up approach. Are we okay here? Okay, so which model to use when? So they have discussed multiple two major classes of models: absolute valuation, relative valuation. So DDM, FCFE, FCFF and RI, and in fact even asset based is the absolute valuation model. But if you're using price to earnings, PS, PCF, then these are all RVs. RVs, or at times we also simply refer to them as comps, comparables. So there's also a new term which is called pair trading. Pair trading is simply buying one stock and selling other stock. So a lot of hedge funds, they use mathematical algorithms to this. So they try to build that pair in such a way that your net beta exposure to market is 0, which is called alpha beta separation approach. So you keep your betas to 0, but you try to generate positive alpha through that mechanism. So they refer them to this too as pair trading. SOTP, valuations, conglomerate we've discussed. Do you understand what is sensitivity analysis? So understanding sensitivity of your estimate to one particular input variable. So if you have a financial model, and if you just change one variable, maybe instead of a perpetual growth assumption of 4%, you keep it as 3%, then by what amount the valuation will change, that is sensitivity analysis. Are you following this? So typically most of the equity valuation model, there's a very large focus on revenue growth assumption, because most of the model is dependent on how do you model your revenue, and there is large focus on K and G assumptions. So typically there are sensitivity models built around these parameters. Then what do you think is a control premium? So if you are buying a stake into a company and that would result into transfer of ownership from one party to another, then you would end up paying a slightly higher amount than what you would otherwise would have paid for a smaller stake, which is referred to as control premium. Lack of marketability discount. So you are trying to value Flipkart, for example, with their recent huge downgrade in valuation. But let's say you want to value Flipkart, and a comparable company, hypothetically, let us say Shopper-Stop, which is a listed company. Flipkart is an unlisted company. So if Shopper-Stop is being valued at an earning multiple of 22, what you might say is that since Flipkart shares, which is not a listed company, would be relatively illiquid, therefore you would charge them a lack of marketability discount. And then illiquidity discount for those stocks which are listed but not liquid. So these stocks you typically see trading at a valuation lesser than their intrinsic value, and that happens because of the illiquidity discounts. Have we discussed blockage factor? Should we go ahead? Sorry? No. Control premium is different concept, goodwill is a different concept. Okay. So who are sell-side analysts? the ones who are selling their research and expecting to generate revenue through brokerages. And buy side analyst, the ones who would be using the research to take valuation calls onto the stock. Is it B? So communicating valuation results, as in this is the part where you write report and you disseminate to all the important clients. So what should we have in the report? We have intrinsic value. We also have key assumptions. So if you saw the report that we just saw, they had assumption about what was their earning estimate and revenue estimate, historical statistics about the company. Then there is a discussion in the curriculum about what should be the format of research report. And the discussion is more or less in line with what we saw previously at the beginning of the session. And research reporting responsibility is all of your ethics in terms of whether you can have discrimination reporting first to certain set of clients and reporting later to other set of clients. So in ethics, we have communication of results with clients and prospective clients. So repetition of the same points here. All right, so name of the reading. This is substantially more interesting theory readings at level 2. It is still theory, but I think the discussion is more on the practical levels. It's more fun. If you ever become an equity research analyst and you're being asked to value a stock, more onto the valuation part, then you would come across lot of practical questions. For example, in a lot of models we make use of RFR. So when you estimate RFR, which RFR or which risk-free rate should we use? Should we use the yield on a treasury bill, or should we estimate yields from treasury notes, or should we estimate yields from treasury bonds? Because most of the time there would be some difference between these yields. Plus you'll have questions like how do I estimate risk premium on the market, right? Equity risk premium. So should we take equity risk premium the way we learnt at CFA level 1, which is return on market minus RFR, or should we use some more statistical and more practical approaches of estimating this risk premium? So there's a good discussion on how to estimate risk premium. There's a very good discussion on the appropriate way of calculating beta of the stock. Right, so at L1, we were just thrown a formula which was covariance divided by variance. But in real life, when you're estimating beta of a stock, what is the time period you should be using? So for example, by default on Bloomberg, you would use a 2-year data, weekly data for 2 years. But some of the analysts might use 5-year monthly data. So then on what parameters you decide what should be the interval to be taken to estimate beta of a particular stock. Are you following this? In the same fashion, which equity valuation model should be used, or which cost of equity model should be used? So at level 1, we knew CAPM, but there are multiple more models. So there is arbitrage pricing theory. Then we have multi-factor economic model. We have statistical model. We have Fama-French. Then we have Pastor-Stambaugh. So there is a lot of discussion on different types of model for forecasting cost of equity. So I have a small example here to show you. This is again the same model that we saw in previous reading, Hindustan Unilever. So here the cost of equity that we have decided to use, if you can observe the formula, this cost of equity is calculated using a basic CAPM model. But not necessarily that CAPM is an appropriate model for all category of stocks. Maybe in case of a very large cap, robust stock, CAPM would still do the justice, but CAPM might not work everywhere. So again, if you'd observe, we have a risk-free rate. So what are the sources through which do you extrapolate this risk-free rate? Equity risk premium, which is again an assumed number, 7%. So what are the ways in which you can calculate equity risk premium? There are a lot of companies, small players, who do business into the consensus space. Consensus is they go to different players in the market, mostly analysts, and they ask them about what is their opinion of equity risk premium in Indian markets. And then they take all this data and provide averages, medians of this. So how do you estimate this equity risk premium? All this would be discussed in this reading.